As you're probably aware, SDLT is a self-assessment tax. That means it's the responsibility of the purchaser named on the return, and it's their responsibility to get it right. When trustees are involved, which generally they are with pensions at one level or another, the Schedule 16 of Finance Act 03 makes the trustees responsible as against the beneficiaries of the trust. Most trustees, as we're aware, defer to solicitors, generally the solicitors acting on their behalf when dealing with the calculation of SDLT. But ultimately it's the trustees' fiduciary responsibility, if they believe there may have been an overpayment, to report that to the members of the fund so that they can instruct them to take corrective action. And of course there is only a 4-year window from the date of purchase, the date of completion of purchase, to take that corrective action. So what is the issue? We all know that if you buy a property for cash, you pay SDLT. You do, don't you? The answer is not always. Where there is a connected party transaction, for example, from a partnership, trading partnership or a professional partnership, it matters not, to a person's personal pension or pensions, then there is a partnership on the selling side. And unusually, as we'll explain in more detail, even where the seller is a partnership, it can impact the SDLT of the purchaser. One of the most widely discussed areas of this over the last few years, but actually it's been around since 2007, is partnerships transferring or incorporating. We've seen a lot of buy-to-let private rental sector people incorporating over the last few years. And if they're in a partnership and they go to a limited company, there is no SDLT. Because the partnership provisions, again, which we'll talk about in more detail, which are an anti-avoidance provision, as the Baroness has pointed out, overruled the general rules. And what that means is cash is ignored. So if you actually look at the paradigm situations that pensions may be involved in. So bearing in mind that if there's a partnership and it's connected, where might the situations be nil? Well, we've just talked about this partnership selling or contributing. This is where the counterintuitiveness starts to kick in. Their commercial property into their SIPP or their SSAS, the stamp duty will be nil because the seller is a partnership. Similarly, owner-managed business limited company, where the property is still held by the shareholders, and again, if you're small business and medium business advisors, you see this all the time. It's pretty good accountancy advice, it's good risk management to leave the asset out of an incorporated trading business. But they then rent it to the company. They then take a decision to get even more tax benefit, tax-free roll-up of income, tax-free capital gain, by then selling the factory, office, whatever, into a SSAS. Again, if it's a jointly owned property that's already economically active, it's rent, that's a partnership for SDLT purposes. None of this 10 hours a week business, it's a partnership. And again, the rules will reduce it to nil. In certain circumstances, multiple schemes, or indeed multi-member schemes, are partnerships for SDLT purposes. The reason being is that in each of the individual members of that scheme are a legal person. You have multiple persons collectively in a scheme. And that meets the SDLT definition of partnership. I'll explain a little bit more on that in a bit more detail in a while. In fact, here we go. The stamp duty definition is much, much wider than for other taxes. It basically takes Section 1 of the Partnership Act 1890. It's a relationship which subsists between persons carrying on business in common with a view to profit. Well, pension funds and its members are persons. Rental income is property business income. So we have persons, we have business. And passivity, we talked about this 10 hours a week for income tax, which is a sideways loss relief issue. It's not really to do with this, but specifically Finance Act 2003 actually has this term, property investment partnership. Well, clearly that can't be an active trading partnership. Therefore, passivity in terms of holding and managing the investment on behalf of multiple members is not a concern for SDLT purposes. It's still a partnership. So basically any joint ownership with an economically active asset is a partnership for SDLT purposes. And what was really interesting, and I think it was Tim Kirby at WKM Wealth pointed this out to us about a year ago, a lot of multi-member pension schemes are actually registered for VAT as partnerships under the partnership rules. You'll shoot me now, I think it's section 46 VAT A84, but it's all in the manual. So I don't think there is any real question that MM schemes are partnerships. So as we've said, the Schedule 15 Act provisions override the general rules. In some cases we've actually come across where properties have been sold and leased back, and they've even missed the lease back relief, which is crazy because Section 57A has been there forever. But then again, Schedule 15's been there for 15 years. We've already done some refunds, and I think it's important to emphasise this. We've done just over 38 pension scheme refunds. HMRC have 12 months to challenge whether or not they accept that refund. Of the 38 we've done, 27 have gone over 12 months, no challenge. It's been settled law. We've been involved in this area as practitioners pretty much since 2007. In the case of other Schedule 15 transactions, in the last 2 years alone, we've done 79, 60% have gone over 12 months. We simply have, in this area, outside of pensions, we have never had the revenue challenge it. And next point, please, Roger. Because of the nervousness of the industry, we actually went and obtained 2 statutory clearances for HMRC from this treatment. The conservative amongst you might say, well, why don't you do a clearance on every one? And the answer is, once you know what you know, you don't need to keep going and getting clearances. Besides which, you have a tendency to, we say, hack HMRC off if you keep sending them the same clearance with different names and numbers on it. It's not good form. As I say, we've done over 1,000 of these since 2007 with no disputes. I'm going to hand over to Roger now because I think he wanted to talk on this point.
Very quickly, this one is a pension a trust or not? We're going to return to this issue later on, but basically, does everybody here accept that a pension is normally a trust? There are some contractual pensions, but the vast majority we come across are set up as trusts. If we're happy with that in this room, I can move on quickly. Those of you who work in pensions industry a lot will know the Finance Act 2004 was a major change in the pensions area. There's a lot of changes within Finance Act 2004, but also there are a lot of statutory instruments or regulations published shortly after the Finance Act, and later on you'll notice that quite a lot of them talk about pensions as trusts, pensions as settlements, trustees. They don't say a pension as a contract or a pension company, right? And the other thing is they do talk about, they widen the definition of trusts and pensions later on, but I'll go on to that on another slide. Pension assets are taxed because they are held for the purpose of a recognised or registered pension scheme. They're not taxed because they're owned by a trust, and the legislation sees through the holding structure. So it doesn't look at the holding company, it doesn't look at the insurance bond, it doesn't look at the LLP, which a pension fund may be part of. For tax purposes, it looks straight as, is the asset held for the purpose of a pension, as to whether it's caught by tax or not. And that is and it's treated as if all the assets are held by the trustees. Again, pushing us into the direction that this is a trust, not a different type of arrangement. A key issue with SIPPs and SSASs, apart from, I don't wish to insult anyone, but a lot of trustees are scaredy cats. They don't want to be caught holding an asset that goes in their hands. They prefer to hold the assets through companies, right? And they don't want the responsibility, if they don't have to, of management. So for a SIPP and a SAP, generally speaking, the beneficiary, either the sponsor who introduced the money or the beneficiary will appoint an agent to manage it. They'll either manage it themselves or they'll delegate it. That means the beneficiary of the pension scheme or the settler of the pension scheme actually controls and manages the pension scheme. Again, this goes towards flavouring whether you have connection or not. between the parties. Now, there is a council's opinion out there which says, nah, pensions aren't trusts for tax law. And what they're looking at is section 620 of ITOIA, the Income Taxes, Trading and Other Income Taxes Act, 2005. Their argument is based on a 1979 House of Lords case, which was nothing to do with stamp duty, land tax. Stamp duty, land tax didn't exist back then. It was to do with converting income into capital using annuities and a tamed charity. And the House of Lords had to look at it step by step, because this was before the Ramsey principle came in, where you just look at the end thing. It was 4 years before Ramsey. And the House of Lords, well, happily, they turned around to tax and pay and said, you've won against the Commissioners for Inland Revenue. But they did say that on the previous case, whether the arrangement was a trust or not depended on whether there's bounty. In other words, have you done a transaction at an undervalue? In fact, they were looking at a 1967 case. So the idea of whether something is a trust, depending on whether there's bounty or not, has inserted itself into the case of pensions. Now, I'm not going to disagree with the House of Lords. They may have better brains than me on this subject. They undoubtedly have a lot more people looking at it than me. But I think it's a bit of a red herring, right? SDLT has its standalone definition of what a settlement is. It's not relying on Section 620. As you heard Rolls mention earlier on, people look at stamp duty and get it wrong, because stamp duty land tax is a completely new tax, completely divorced from the old tax. So whilst you can look at income tax or capital gains tax and say that the current legislation is a codification of the previous law, so old case law will apply, you can't do that so readily for stamp duty land tax. Particularly when stamp duty land tax has its own written out definition. That's much harder to disrupt that definition. What is the definition? A settlement is an arrangement, it's quite a long one, but it's arrangement, transaction, blah, 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 or trust, anything which is not a bare trust. Now, I'm going to come back to this later on, but it's quite clear, if you've got something which is where there's a trust, and it's not a bare trust, which is basically somebody who's acting as nominee, and a pension clearly is not a nominee situation, right? Then you have a settlement, and it brings you back into the connected party discussion. Shall we quickly talk through Section 1122?
Well, I don't think we probably know. I mean, most of you are probably familiar with the idea of connected parties. It's a wide-reaching concept. I think the important thing, as Roger has said, is that this talk about pension schemes not having an element of bounty, therefore not being a trust, is an absolute sending you down the wrong road. Schedule 16 captures them, as Roger says, anything other than a bare trust, which clearly they are. And it also, Section 620 ITOIA, it may get pensions out of connection for income tax purposes, but it's Section 1122, as adopted into Schedule 15, that matters. And there is, without a doubt, between those two definitions, it creates the connection. So, the definition of settlement in Section 620 clearly does not exclude pension schemes, even if there is no bounty. If it were the case, why are there so many statutory references in Finance Act 2004, Chargeable Gains Act, the Inheritance Taxes Act, etc., 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 specifically taking recognised pension schemes out of the charge to tax? If they were never in it by virtue of this early House of Lords case, we wouldn't need, the draftsman would never have needed to exclude them. So I think we can kind of dismiss that.
If I can cut in on David just at the moment, he's gone back to whether there's bounty or not, right? The bounty question is for an income tax for 620, but you ask the council a question, he or she will answer the question you ask in the manner you've asked. they've asked specifically about whether there's bounty. Now, a pension has contributions to set up the pension. Those are in return for retirement benefits later on. HMRC, in their manuals, specifically state that where there's a transfer of assets and the only consideration in return for that is giving the benefit of a pension right or similar right, then that is not consideration. So the benefits you're getting under the pension are not consideration for the property put in. So what we have here is somebody sets up a pension scheme, standard, they'll put in a wad of money. Sometimes it's £5 to establish the trust and everything else goes in through loan. Other times it's something substantial. That first transaction is in return for the pension benefits. It is therefore not, there's bounty there because there's no consideration for it in tax terms. Now later on, you might have an arm's length sale of the property for full value. Doesn't matter, you already have the settlement. You already have the vehicle to which the parties are connected. Sorry about going off, I'll just return to David on that now.
No, that's okay. I mean, thanks for that, Roger. I mean, if this Pump Court summary opinion is correct, and I would argue it's not, then there would be absolutely no reference to connected persons in the pension schemes manual. And we all know pension schemes office, they don't want loans back to participators, they don't want loans to connected persons. They don't, there's a whole raft of references to connected persons. Again, points to the fact that this opinion is wrong. And in order to not invoke Schedule 15, HMRC would have to say that the pension scheme members are not connected to their scheme. And they clearly do not. Quite the other way round. And we've never actually disclosed this in earlier briefing, but 2 years ago we got a council's opinion on this point from one of the leading stamp duty counsel and authors in the UK. And he absolutely 100% agreed with us. By the way, the reason we keep swapping this microphone is this session is being recorded and you will be sent a link so that if you want to replay it. So, why is SDLT not due? Let's go into this in some depth. These are the partnership and connected party provisions. SDLT is normally calculated on the price paid or market value. The partnership rules kind of overrule this, and because they're an anti-avoidance provision, you do not get a choice. This is not a relief you claim, you have to do this. So the way it varies is to say that the calculation of SDLT, the amount chargeable is the market value, well that sounds kind of familiar, times 100 minus the sum of the lower proportions. Welcome to algebra, HMRC style. Makes about as, it's the revenue's gift to mathematics is about as good as the FCA's gift to plain speaking, so. But the SLP is the profit share of all persons connected inside the transaction. And with a pension scheme transaction, it's usually 100%. If we take the basic simple paradigm, husband and wife in business together, let's call them Joe and Pete. They trade from their offices. They undertake a sale and lease back to a joint SIPP. Well, the SIPP pays $500,000 in cash, and ordinarily you'd expect 25,000 in SDLT. But it's actually nil, and here's why. Joe and Pete are a partnership, they're trading, they've got an office, fine, they're connected to each other by marriage, and they're both connected to their SIPP. The SIPP calculation proceeds under Schedule 15. They're both connected. The profit share of the connected persons is 100%, so that's the SLP. 500,000 times 100 minus 100. Hands up if you can get any different answer than nil on that one, but I just, you know, and that's the answer. And that's what we've been doing, and that's what how we've been claiming refunds with full disclosure to HMRC, because they won't just send you a cheque, you have to send them an explanation of why you want to cancel the return, and we've been getting the cheques back. I want to go just for a few seconds before we sort of go to the conclusion,
just go to one of the points here. We have a situation where solicitors have taken the obvious route. Oh, there's cash involved, therefore there must be tax. Unfortunately, it's the wrong answer. I nearly said the wrong trousers, but you understand what I'm saying. Is number of times, and I'll tell you a war story in a minute. We see solicitors literally gloss over the facts, much less the law involved in a transaction, is horrifying. During the 2 years of the pandemic, we recovered over £15 million in overpaid SDLT. Just this morning, I got a phone call from a chap who said, I'm buying a block of flats in Manchester with 6 garages, £2 million, and my lawyer has sent me a bill with 10% SDLT on it. It's one of those jaw-drop moments to a stamp duty practitioner. It's like, how could that happen? And when I checked out the calculation, they treated the whole building as if it were a single dwelling and liable to the 3% surcharge. They hadn't looked to see whether there was multiple dwellings relief. They hadn't looked to see whether they could get the rule of 6 and get it down to 5. They just hadn't looked. I don't know why, but this is the sort of thing we see. And I think this is where the problem has arisen. So if you've been involved in pension property transactions, for new transactions, ensure that the advisors are getting advice about the transaction. And ideally, that use somebody who is aware of the SDLT rules. If they're not aware of the SDLT rules, tell them you need to go and check this. You must get this checked. For past transactions, go through your back book. You're looking for more than one seller, more than one purchaser, or more than one purchaser, or both, or one seller and more than one purchaser in terms of members of a scheme. Those are the kind of situations you're affected. Fred Smith selling to the Fred Smith SIPP on his own, not affected. It sounds anomalous. I would agree it probably is anomalous, but nevertheless it is right. If you find them, you can apply for a refund. You can tell the clients, or if you want to make their day, do the refund anyway, and then tell them and give them a nice surprise. And that's really all you can do. And at that point, in order to avoid boring you rigid and recognising that you may well have some questions like, where are the bathrooms and is there a smoking terrace out here? I shall throw it open to the floor. Thank you very much for listening and being hopefully attentive.